Hello everyone and welcome back to the channel. This is Fair Value Finder and today we are taking a look at Darden Restaurants Incorporated. We looked at a restaurant stock the other day and I wanted to take a look at one that I have owned. I still own a little bit of it. I bought it as a dividend stock and it definitely looks to still be a reasonable dividend stock. So this group owns restaurant brands such as Olive Garden, Longhorn Steakhouse, Cheddar's. Those are the main ones that I'm familiar with, but they also own Yard House, The Capitol, Season 52, Bahama Breeze, Eddie V's, and they pay out a decent dividend. So I'm coming up with a fair value of around 152 and a half. It's currently trading for 154 and a half, and it's been as low as 133, as high as 176. So you're getting the midpoint of where it's been within the year at this point, and it's just about in line with the fair value of the stock. Earnings yield, not too bad, could definitely be better, 6.7%. So we'd be looking for them to come in with an EPS at least 773 for the valuation it's currently trading at, and it's definitely doing that. 8.59 last year, 8.85 this next year, and 9.62 2025 according to analysts. Cash flows, not too bad, not quite double digits. They always come in just shy of 10%. They were actually pretty low this last year at 8.5. Dividend yield, 3.5%, right where I like it, although their payout ratio is creeping a little high, almost 59%. We really want to see that under 50%. Some decent growth in the earnings, though, so they might be able to grow into that. ROE, super high, super diluted, 3.65 debt to equity, so kind of take that for a grain of salt. ROI, decent, almost 9%. ROA, pretty good too, 10.1%. So those are not bad. This is a little concerning, but owning all of that real estate and all of the equipment that goes into running a restaurant, it's pretty reasonable for what they do. Margins, they came in higher this last year, 21% growth, usually around 20 and a half. Net, they seem to be right there, around 9.25, 9.3%. Revenue going forward is kind of all over the place. Next year, analysts are expecting just shy of 2% growth, and the following year, we'd be looking at a compound annual growth rate of 3.4%. So a pretty big jump is expected for 2025, as we saw by the earnings, by the EPS as well. So 2.8s in between those, that bringing them up significantly, but not to any extreme degree over the next 5 years in revenue. Share count, they're constantly buying back shares around 2.5% almost every single year. So that is something that we like to see. That's very good. That'll actually help them with their payout ratio as well. Buying up those shares, being able to keep that cash themselves. Cash flow growth, 2.5% seems to be pretty fair here. Keeps them in line with what they've historically done. Asset growth, it's pretty flat. 1 year it's plus 1%, and then it's minus 1.3%. So we can keep it flat, at least for now, see how things play out. I mean, it would be nice to see them slowly increase those assets, but in order to do that, they'd probably have to open some more restaurants, and that'd be quite a bit of debt that they'd be bringing on as well with those assets. And liabilities, slow growth there as well. 2%, 1%, so we're going to stick with 1% for their thesis here. Dividend, 5% growth seems to be pretty fair for them. That'd bring them to a dividend of 6.94 in 5 years. Not too bad. A yield on cost, if you buy at today's price, you'd be looking at 4.6% yield, which is very good. I do like that. They're clearly a dividend stock. This growth isn't necessarily to the degree where I'd call them dividend growth stock. They're an established company with a good dividend yield and reasonable payout ratio, at least for now. Margin growth, I'm putting in something small. We'd like to see them grow it over time, but they seem to be pretty flat around that 9.3%. Even this would only bring them up somewhere in the realm of 9.5 over the course of 5 years. So if this is our thesis, what we'd be looking at is buying at today's price, 18% growth in the fair value of our position over the next 3 years, and 36 in the next 5 years. So both of those are underperforming the market. The dividend is factored in here. 8% underperformance in 3 years and 11% in the 5 year. So although it might be at a fair value right now, the growth doesn't quite warrant buying it. They're only looking at 4.7% growth, and then the rest of what you're making is coming from that dividend. So that's why I say, as a dividend stock, it's not bad. It's one of those dividend stocks where I don't think that the share price is going to move a whole lot on you, and you're going to get paid out a consistent dividend, which is very nice. They did pay significantly less during the shutdowns back in 2020. So that is something to be aware of, that they are willing to suspend their dividend if things go south. To be fair, I'm sure the majority of their locations were closed and they didn't have any revenues for a time. But that is something to be aware of. It's one of those stocks where if you like their brands, Cheddar's is probably one of my favorite restaurants. Olive Garden, I enjoy as well. So I wouldn't mind owning those brands, and getting paid 3.5% on my position isn't too bad. If they do continue growing this 5% and my position grows along with that fair value, then I would not mind a 4.5% yield at all. That's decent for sure. Now, it's not going to outperform markets, so I wouldn't put a crazy amount of money into it, but it is something that I would purchase as an investor interested in the brands. If we look at all of the price, all of the valuation metrics graphed out real quick, we see back in 2020 they paid out partial dividend, and then it jumped significantly when they paid the full thing in 2021, and they're clearly on a dividend growth trajectory here. That's where the majority of the value is coming from for this stock. Fair value, kind of lagging way down here, seems to be getting dragged down quite a bit by that balance sheet, which almost looks to be on a downtrend. Staying pretty flat around that 50-ish dollar mark. So not a lot of the balance sheet is being factored into the share price. Then we have earnings. Very nice linear growth from 2021 onward. And finally, we have cash flows, which seem to have leveled out. There's not a whole lot of growth in there compared to everything else. And then we have the actual share price. So share price was clearly leading all of the valuation metrics back in 2021. Saw a big pullback down to where it was lower than the fair value and everything else. And since this last year, over the course of 2024 so far, we've seen it run up from quite a bit below the fair value. $20 on a $120 stock isn't some small amount, but it's currently almost right in line with the fair value, assuming analyst projections and our thesis are true. So that is all for this one. I'd really want a bit more of a discount for these small returns that you're looking at. Like, if I could have bought it back at that 52-week low, 133, I'd be happy. I'd be very happy with that. Definitely be a stock that I would hold on to for the long term, and your yield on cost could potentially grow up to over 5% over the course of the next 5 years, which would be very good. I might just have to watch this as a dividend stock, and if it dips down to 130 again, maybe pick a little bit more up. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks you want me to take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.